So I'm looking through your picks here, and the consumer plays big into this, whether we're talking about housing overall or just discretionary consumption. I'm thinking specifically about Sherwin-Williams and Coca-Cola. Sherwin-Williams did well in its last report. It's up 6% today, but it's also getting back up to recent highs. So why are you sticking with it here, and what does this say about what you believe the consumer is going to do in the back half of the year?
Yeah, I think it lends to both of what we talked about with regard to the consumer is these are resilient companies. These are companies that still get spend even if the consumer starts to soften a little bit. And you saw that in this earnings results for Sherwin-Williams is that, their competitors were down more than that. And there was a lot of fear that this quarter was going to be a reset quarter, if you will, and then a potential acceleration going forward. And while the revenue was still a little soft, the earnings came in significantly better than expected. And I think the overall guidance and the thoughts on the stock itself seems to be relatively positive to where they can recapture some of that, let's say, loss from the interest rates that have been so high here recently, that if rates come down, we could see more housing transaction velocity, and that could lead more painting, obviously, as a result of that. And so that's why we really like the execution of Sherwin-Williams, and we're going to stay the course here on that name.
But that brings me to the real question for me about the consumer, which is, even if rates come down a bit, sure, we see a little pickup in mortgage activity, refi activity, people getting some cash in hand, needing to do stuff. But if they stay generally higher for longer, doesn't that keep a bit of a brake on the economy? And, there's only so many cost cuts that companies can do before they have to either restructure or just say, hey, see us when we got some top line growth, right?
Yeah. We've often said here, you can't cost cut yourself to prosperity. You just can't do it. You got to have growth at the end of the day. So in that side, if the consumer, now again, in rate cuts, if it's 25 basis points, does that really do anything for the consumer? We would argue not a whole lot. 50, if you're talking about 2 and 3 by the end of the year, could have a little bit of an impact. But for us, it's much more the reason of why we're cutting. Are we cutting because we've done the job in inflation and the consumer remains resilient? Or are we cutting because economic and earnings growth is starting to show some cracks? Now, our best case and base case scenario right now is that it's the former, that we're cutting because inflation is getting normalized, if you will, while the consumer is still relatively resilient, even if they're starting to slow a little bit. If we see a change in that to where an earnings season will be, frankly, a large determinant of our thoughts on this, is if we start to see enough of these companies saying, we need to start adjusting our growth metrics because the consumer is weakening, then we'll pay more attention and we'll have to pivot as a result.
Yeah, and we spoke last hour with Chris Grisanti, who is convinced that this is kind of the happy kind of rotation, and that it's not a sign of a market that's kind of ending its run. It's really a sign that it's broadening out, and a lot of other kinds of stocks can do well, the kinds that haven't done as well in the past 18 months.